We've talked a bit this morning about what drove the quarter. In terms of color out of the commentary, it seems like the themes are controlling expense growth and remaining cautious, maybe some seasonality in there too. Does that sort of describe where we are?
Well, yeah, it does. We had a really nice quarter, $10 billion of revenue, strongest third quarter we have in over a decade. The results were really strong across all three of our businesses. As you said, the institutional securities business had nice results. We had a constructive market backdrop, a little uneven, but constructive. Equities number one. Our investment banking business did very well on the back of debt capital markets as well as M&A. And our fixed income business continues to gain share. Wealth was more around expenses. A really nice story there with over a 28% margin. And IM just continues to grow. The growth story is intact. Good flows. We surpassed $500 billion. So a nice quarter, generating 11% ROE. So we're pleased.
When Gorman says he's maniacally focused on making sure revenue growth outpaces expense growth, what does that mean, maniacally focused?
Well, I think it means what it sounds like. We are very focused on expenses. We have been for quite some time. We've committed to our investor base that we will be disciplined when it comes to expenses, and we'll take the required actions that we need to take to make sure that we maintain a good expense base.
Typical, what's the word here? Typical summer slowdown. Was seasonality any more pronounced this year than in past years?
Probably not. We did see a real slow August, which is pretty typical, but I think what we saw, which was a little bit different than last year, is we saw a nice pickup in September. People came back from the holidays. The markets were constructive, and people wanted to do strategic things, and we saw a lot of activity, a very strong September.
I noticed, Jonathan, on the call, you got a number of questions about the online brokers' rapid move to zero commissions and whether that's going to impact any of your guys out in the field. Why wouldn't it? Why wouldn't that be something that perhaps a Morgan Stanley customer would at least come to their financial advisor and say, hey, why am I paying?
Yeah, I mean, it's a fair question, but I think we have a different business model. We also have a different client segment, right? Our clients are looking for more than just $0 execution. They're looking for financial planning. They're looking for advice and service. That's really the value proposition today. So, it's not helpful that the execution is going to zero just as a macro backdrop, but we don't think it's going to significantly impact our business today.
And when it comes to costs overall, non-comp, I mean, the reason Gorman said we're maniacally focused is because I guess non-comp expense had risen a bit more than had been anticipated this quarter. Is that just a quarter-to-quarter thing? People shouldn't read into that at all?
Yeah, no, that's a quarter-to-quarter thing. And as James said, our efficiency ratio is about 72% year to date. It was a little higher this quarter. That was really driven by a lot of client activity and some of the execution costs related to that activity. But again, we're very focused on the expense base and delivering on our commitment to investors.
On the big macro questions, Jonathan, obviously there's Brexit news today. We just talked to Kudlow about China. Who knows what will happen? I guess the question is, are you seeing uncertainties resolve on large questions, even at the margin, and the implications you think that might have specifically for rates?
Sure. Well, listen, there's lots of uncertainties, and you just highlighted a couple. And anytime any one of these get resolved, it's generally considered a positive for the market. Clearly, the Brexit news today is good news. Hopefully, that'll get approved and get done. But there are still a lot of uncertainties around China trade. That seems to be the one that the investors are most focused on. Clearly, some sort of positive outlook or resolution of that in the near term would be a positive. And I think if you listen to the Fed chairman, that will have an impact on how they think about rates. The U.S. economy is still healthy. Labor market is strong. Wages are growing. And he's talked about global developments impacting their view on rates. So if we can resolve some of these issues, presumably that will be taken into consideration.
And when you look at the overall worldwide rate picture, I mean, we still have conversations here, given we've got, $15 trillion or so in sovereign securities negative, that it could come here. What do you think, Jonathan? Will we ever see negative rates?
Well, I certainly hope not, and I don't think we will, based on what we're seeing here. But Clearly, the negative rates have not really been helpful to spur the economy in some of these markets, and we'll have to just see how it plays out. But this negative rate dynamic continues to have investors searching for yield, and I think that's a trend that's going to continue because not only are there a lot of negative rates, if you look at the stack of debt products out there, there is not that much inventory that's yielding over 5%. So on the one hand, you have a lot of negative rates, and on the other hand, not a lot of places where you can find yield.
And given all the connections Morgan Stanley has on both the retail front and obviously the corporate front, and you're connecting to all the different people at the firm, what is your sense right now overall of confidence out there? And just generally speaking, what do you think in terms of the economy?
Yeah. Listen, from our perspective and my perspective, the economy here in the U.S. is quite good. We certainly don't see a recession as a base case in 2020. Growth is going to slow a little bit, but it's actually quite healthy. The consumer is quite healthy, and we're pretty positive overall on the U.S. economy. In terms of confidence levels, the CEOs that I talk to remain very confident. They want to do strategic transactions. They want to implement strategic initiatives. Clearly, if you had less uncertainty, that would be better. But it just feels like CEOs want to get along and initiate some of these strategies, and I think you're going to continue to see that. The retail side, a little bit more cautious. Last year, we saw a big rotation into equities as we had sort of global synchronized growth and the tax cut. This year, we're seeing less of that. New money is going more into fixed income product and short-term securities, but the investors still invested. They're just a little bit more cautious.
I don't want to throw Mike Wilson back at you, but your own macro strategist offers a daily diet of reasons why CEO confidence is at a 3-year low, CapEx slowing, labor rolling over, inventories are bloated. Do you ever have discussions about why he says even today we're in the midst of an earnings recession?
We have a lot of discussions, as you would expect. Good dialogue between all the different people within Morgan Stanley. Listen, I think we are seeing the focus on earnings season. We'll have to see how earnings play out here. The banks have basically reported, and they look pretty good across the board. We'll have to see how the other sectors do. People are very focused on earnings. But again, as I say, I see a strong U.S. economy, slower, but still expanding. And Mike and I probably have a slightly different view on opinion here.
Finally, Jonathan, what did you guys buy back this quarter in terms of stock? How much was it?
We bought back $1.5 billion, about 36 million shares.
Right. I mean, we can expect that to continue in terms of your overall return of capital to shareholders?
Yeah. Coming out of CCAR this June, we announced approval to do $6 billion in buybacks and raise our dividend, and that's our current plan.